U.S. inflation continued to accelerate as consumers' prices rose, up 3.5% from a year earlier. The threat of inflation probably leaving the Fed with little room to cut interest rates further. To talk about the state of the U.S. economy and the impact on the markets overseas, we're joined in New York by Steinmetz. He's head of the International Fixed Income Team at Oppenheimer Funds. He helps manage more than $20 billion in assets, including Asia. It's good to have you with us, Art. Now, do you think that today's CPI report is going to make the Fed think twice about cutting rates soon?
No, I think at this point we're still looking at the short-term credit problems. Inflation in the U.S. is mainly a service sector phenomenon at this point, so rising energy prices, which continue to plague a lot of countries around the world, are not a big factor in the Fed's calculation.
So there is no risk at all that the Fed might raise rates next year, or is there?
Well, by the end of the year, we could be talking a different story. But in the first half, I think we're in the middle of a good old-fashioned slowdown in the United States. And there's possibly, maybe probably, another cut or two in front of us from the Fed, because they'll find out that inflation remains pretty well behaved in the United States. With a little luck, the second half of next year will already start to look better, and then the Fed will be in play again for possible hikes.
So going by that assumption, until the Fed starts raising rates, you'd want to be assuming more interest rate risk going forward.
Generally speaking, yes, that's true. As a global investor, I think about where the best opportunities are, both in rates and in currency. And that suggests that the U.S. dollar is going to remain weak. So I think the currency opportunities are still pretty exciting in some places.
So where's the best opportunity for both rates and currency?
Well, my old favorite has been Brazil, and that's still the case. Because again, if you look at places that have high real interest rates, that is, high rates relative to inflation, and legacies of high inflation that keep the risk premium big, but where the policies recently have been much, much better, that leads you to some interesting areas in the world. And Brazil is probably the single best example of that, where they still have high real rates, a legacy of high inflation, but a central bank that is showing really very, very good discipline and generally a balance sheet that's much better. So they have paused in their interest rate easing cycle. So to us, that has suggested that the currency ought to be reasonably strong in an environment where the Fed here in the U.S. Is cutting rates.
Yeah, but Art, just how much longer are you willing to take on the currency risk in Brazil? Because the last time we spoke to you, you said that the rally was more than half over.
That's right. I think that's probably true. And we're approaching about 170 versus the U.S. dollar on the Brazilian real, and you're getting to a level where that could be done. But, that's contingent on a couple of things happening, and that is a short easing cycle in the United States. As I said, I don't think the easing cycle is done, so we're probably still reasonably well supported. By the same token, as long as inflation as long as inflation looks a little problematic for the Brazilians, as it has started to recently, they're going to have to hold off on what is still a multi-year easing cycle in front of them. And that will continue to be supportive for the currency. When the Fed is done cutting and perhaps in the latter half of next year is looking to hike rates again, and when the long-run inflation trends in Brazil, which are down, reassert themselves, then I think the story is probably done for the currency. And then the rate story becomes very interesting again. That is, with rates, nominal rates in Brazil higher than 12%, suggests that they would have some room to fall. So the leadership rotates.
Now, what about here in Asia when you talk about the emerging markets here in the region? What is a bigger problem, you think? Is it regional inflation or strengthening currencies?
Very good question. The currencies in a lot of Asia haven't strengthened versus the dollar, and when we want to point fingers, we know exactly where to point them first, and that's China, of course. The Asian currencies have a little bit of a problem, or the Asian economies have a little bit of a problem. They've been very, very reluctant to allow their currencies to appreciate much against the dollar, but at the same time, inflation is rising very dramatically. Of course, China being the most interesting example there again, where inflation is up from maybe 1.5% at the beginning of the year to close to 6%. in a region where monetary policy doesn't have the same kind of strong transmission ability that it does here in the United States, that leaves them with administrative measures and currency as tools to possibly fight inflation. And these economies have been very, very reluctant to do that. So money supply growth has been very large. These countries have not been sterilizing the capital inflows anymore to the degree that they were able to a couple of years ago. So inflation is going to become a much, much bigger problem for these guys going forward unless they take sterner measures to curb it today. And part of that solution, in my opinion, has to be currency appreciation.
All right, we've got about 30 seconds here. You've got no Asian corporates in your bond fund, but you've got sovereign bonds in Indonesia and the Philippines. Are you sticking with those?
Yes, and Philippines continues to be an interesting story where, again, it follows a different model than some of our other countries, but the model is bad politics, good economy in the Philippines. There's a risk premium in the Philippines because of the political situation, but we see tremendous dynamism in the economy. Foreign remittances will remain strong even as the economy slows down, in our view, and good fiscal discipline means that that's an opportunity.
Yeah, it's an interesting combination. Bad politics and good economy. Thank you so much for joining us, Art. Do appreciate it. Art Steinmetz of Oppenheimer Funds in New York. Our week-long focus on Indonesia coming to a close. On our final day, we'll hear from the Asia Foundation about the nation's fight against terrorism. More to come on Bloomberg Live.